What if the AI revolution isn't real and the stocks you've poured money into could crash overnight? AI has gone from being a tech buzzword to what feels like the golden ticket for investors. Companies that even hint they're working on AI see their stock prices jump. But history has shown that bubbles start to form whenever hype moves faster than reality, and bubbles, well, have a habit of popping. How hype skyrocketed AI stocks? It's mid-2024 and Nvidia has just become one of the most valuable companies in the world. Its market cap surges by over $2 trillion, reaching a staggering $3.28 trillion, more than its $1.2 trillion valuation at the close of 2023. This is all thanks to its AI chips, which power tools like ChatGPT and other generative AI software. Suddenly, the headlines can't stop talking about AI everywhere. Social media is filled with posts about how AI will transform everything from your doctor's office to your local burger joint's drive-thru. Retail investors like you and me see this and think, I've got to get in now before it's too late. They start buying AI-related stocks in a frenzy. It's a lot like the late 1990s during the dot-com boom, when simply adding .com to a company's name could send its stock price soaring. Back then, people thought the internet would make them rich in weeks. Today, AI carries that same gold rush energy. In 2024, the S&P 500 jumped 23.3%, and the Nasdaq, heavy on tech stocks, surged 28.6%. Those are massive gains for a single year. But just like in the late 90s, many of these gains are based more on excitement than actual proven profits from AI. The big tech power players. Behind the AI hype are the same big names you see in almost every tech headline: Nvidia, Microsoft, Alphabet, Google's parent company, Amazon, and Meta, Facebook's parent. Microsoft's market value is around $3.1 trillion. Amazon and Alphabet hover at about $2.3 trillion each. These companies are the poster children for AI. Their leaders speak on stage at major conferences, get glowing reviews from Wall Street analysts, and influencers promote them online like they're the future of everything. But here's the part most people miss. Their actual AI revenue isn't nearly matching their sky-high valuations yet. Microsoft reported $13 billion in AI-related revenue in 2024, mainly from its Copilot tools powered by OpenAI models. This is a small fraction of its total annual revenue of $211 billion. Amazon has invested heavily in AI, particularly through AWS, which generated $90.8 billion in 2023. However, AI-specific revenue is still a small portion of that. Alphabet Google has integrated AI into its core services, such as search, YouTube, and cloud. While AI is a growing contributor, it's still part of a broader portfolio that generated $307.4 billion in 2023. Meta, Facebook, has invested in AI for ad targeting and content moderation. However, its 2023 revenue of $134 billion was primarily from advertising, not AI-specific products. Nvidia is a leader in AI hardware, with 40% of its $18.4 billion Q4 2024 revenue driven by AI. Still, this is a fraction of its total revenue. Red flags. Everyone's ignoring. Even amid this excitement, bright red warning lights are flashing. First, AI adoption isn't moving as fast in every industry as the headlines suggest. Many companies are still testing AI tools instead of rolling them out fully. This means the massive profits investors expect might take years to arrive or might never arrive at all. Second, AI is extremely expensive to run. It's not just about building the software, it's about powering it. AI models rely on huge data centers filled with powerful servers, which use enormous amounts of electricity. Experts expect global electricity demand from data centers to double by 2026, mostly because of AI growth. In 2024, tech giants spent over $200 billion on AI infrastructure, like chips, servers, and massive warehouses to house them. By 2025, that number is projected to reach $300 billion. That's like buying the world's most expensive sports car without knowing how much gas it needs or whether it'll actually get you to your destination. Third, there's the sustainability challenge. Companies like Apple invest heavily in AI while promising to meet strict climate goals. However, the more energy AI consumes, the harder it is to meet those promises. This could lead to public backlash, lawsuits, or stricter government rules. Finally, while a few analysts are quietly warning about overvaluation, their voices are drowned out by the roar of the hype machine. What could trigger the crash? The thing about bubbles is that it doesn't take much to pop them. When everyone is overly optimistic, one piece of bad news can change the mood instantly. Here are a few scenarios that could burst the AI bubble. Major earnings miss. Investors might panic and sell if a giant like Nvidia or Microsoft reports profits far below expectations. Sudden regulation. Compliance costs could shoot up, slowing development if the US or the European Union passes strict AI laws. A high-profile AI failure. Imagine a widely used AI making a massive public mistake that causes real-world damage. Right, investor confidence could collapse overnight. Rising interest rates. Higher rates make borrowing more expensive, and high-growth companies suddenly look less attractive. Geopolitical tensions. Taiwan makes most of the world's advanced chips, and any disruption there could choke the AI supply chain. Yes, it only takes one of these events at the wrong time to start a chain reaction of selling. Lessons from past bubbles? If this all sounds familiar, it's because we've seen versions of it before. In 2000, the dot-com bubble burst. Stocks that had been worth billions went to zero almost overnight. Pets.com, one of the most hyped companies of the era, became a cautionary tale about overvaluing potential instead of profit. More recently, in 2021, cryptocurrency prices exploded. Bitcoin hit nearly $69,000 and new coins popped up daily. But when reality set in, prices collapsed, leaving latecomers with heavy losses. The pattern is clear. Hype drives prices up, investors pour in, and people start believing this time is different. But as history shows, that belief almost always ends badly. So how can you invest in AI without getting burned? The answer isn't to avoid AI entirely, it's to invest wisely. 1. Don't chase hype at the peak. If a stock has already tripled based mostly on excitement, it's the riskiest time to buy. 2. Diversify. Spread your investments across different industries. If AI stocks take a hit, other parts of your portfolio can help balance the losses. 3. Look for solid numbers. Focus on companies with substantial profits and cash flow, not just big promises about the future. 4. Pay attention to warning signs. Watch for changes in earnings reports, market sentiment, and even data center energy usage. Do you think investors are heading for a crash in the AI stock bubble? Leave your thoughts below. If you've enjoyed the video, like, subscribe, and watch our other ones.